Susie Allen, Vice President of Insights from Fidelity Wealth Management. Thank you for joining us today and submitting questions. Your questions help shape our discussion. Today's focus is on creating an investment strategy, which is a key part of financial planning. There's a lot to consider, including your goals, time horizon, ability to tolerate risk, and more. We'll explain how it's done and how to adapt your strategy as your life and finances change. But before we get going, please know Fidelity does not give tax or legal advice, and nothing we discuss today should be interpreted as tax or legal advice. The information we are providing is going to be general in nature, and it may not apply to your situation. If you have legal or tax questions about your specific situation, we encourage you to talk to an attorney or tax professional. So, to start us off, I'd like to introduce my colleagues from Fidelity who are here with us today. So I'll ask each of them to introduce themselves and briefly describe their role. So Jen, let's start with you.
Good morning or good afternoon, depending on where you're tuning in from. My name is Jen Selwood. I'm a Vice President Financial Consultant in our Minnetonka, Minnesota Investor Center. And I'm just going to put it out there that likely I have the most fun job at the firm, in that I have the pleasure of meeting with our clients every single day to help develop, support, and implement their financial plans.
All right, well, thank you, Jen, and welcome. Lars, welcome back.
Hey, thanks, Susie, for having me back. Hello, everyone. I'm Lars Schuster. I'm an institutional portfolio manager with Fidelity Strategic Advisors. We're actually the lead portfolio manager for most of Fidelity's managed accounts. And as a member of the investment team, what I do around here is I'm responsible for really delivering our investment team's managed account philosophy, our process, our ongoing activities to just a wide range of investors.
All right, thank you. All right, Phil, last but not least.
Thanks, Susie, and thanks for having me. My name is Phil Holohan, the Regional Vice President for Planning Solutions, and I provide support to financial representatives across the country in a few specific ways. I support and coach Fidelity financial consultants on financial planning topics like investment management, tax planning, retirement income planning, and our goal there is really to provide a financial planning experience we would be proud of every single time.
Awesome. All right, well, thank you, everyone. Let's get going. So, Jen, as someone who works with clients every day, it feels like we should start with a question for you. So, when a client comes into your office, how do you start creating a plan or reviewing the one they have now?
Great question, and this is a great place to start. Every client experience is obviously very unique, so it's really important and imperative that I understand what actually is most important to each client. For our managed accounts, we act in a fiduciary capacity, so not only is it important that I understand the goals of clients, it's also important that I understand the facts surrounding their financial situation. So all of that being said, we start by discussing specific goals so it's clear to me what's most important to each individual client. More often than not, the big goal is retirement, but there are often other goals in addition to that. So think about education goals or second home purchases or perhaps charitable desires. So my job is really just to listen and understand what is really important to that client individually. From there, we compile information just to help build out the plan. So think about this as the granular part of the plan, meaning what is their current source of income or what does their income look like in retirement? What are they spending? This is all about lifestyle. So what are those expenses? Where are their assets? How are they invested? What registrations are they? And certainly we dive into the investment strategy as well. I think it goes without saying that there's a huge psychological component to financial planning. So I spend a ton of time understanding what clients are really excited about, or perhaps what they're nervous about. I often ask, like, what, if anything, keeps you up at night in regards to your financial picture? And understanding clearly what trigger points are help me model plans just to be most effective so that we can, when we do experience market volatility or life events, we don't panic and we're able to actually stick to that plan.
All right, and just to underscore that psychological component, I imagine with planning, it's whether you're planning solo or the partner, family, friends, there's a lot to consider. So, Phil, in your role, you coach financial professionals as they guide clients through the financial planning process. What are you hearing as top client concerns right now?
Sure. Many of our clients are telling us, and they have for years, that running out of money in retirement is what keeps them up at night. What do I do? The primary role of any financial representative is to listen. So, where we work is to ask really tough questions sometimes about things that have happened to you that in your life that shaped your decision making, and it shaped your risk tolerance, and it shaped your investment behavior. From there, we can customize and present very clear recommendations alongside your representative, which seek to improve your outcome, however you define that. In many ways, fulfillment for us is when our representatives can act as a guide and help provide some predictability within all the uncertainty that we often face.
Right. Well, as Phil just articulated so well, helping clients manage money concerns is at the core of what we do. So this feels like a good place to discuss risk tolerance. So, Jen, how do you create clients' plans that balance the need for both protection and growth?
Well, to determine true comfort with risk, we really focus on three main categories of assets for your overall strategy. So, keeping it pretty high level, these three categories are emergency reserves, protection, and growth. So, we'll start with emergency reserves. And just like it sounds, this is where we hold cash or cash equivalents for emergencies or unexpected expenses. The amount of cash held is obviously very specific to everyone's individual needs, but stereotypically, we can say 12 to 24 months worth of expenses in this location. So to handle that emergency should something come up. The second place we look to make sure that we've got assets allocated to is our protection bucket. So we strive to manage income and or principal effectively. Here at Fidelity, we believe that all essential expenses really should be covered by a guaranteed source of income throughout retirement. So assuming that we don't have enough income in retirement, so think Social Security, pensions, or things of that nature, we can actually help build out a guaranteed source of income to cover that gap. Guaranteed sources of income can include both fixed and variable annuities, and certainly depending on client preferences, we determine the best guaranteed income source to fit their need. Now, not everybody needs this income protection, but we still believe that this protected bucket is really important. So if we don't need that income gap filler, if you will, then we look to options to help protect principal. The beautiful thing about our planning software is that all of our tools are really designed to effectively illustrate the role of protection within financial plans. And they show how important it is to have this actual protected piece to the portfolio. And lastly, growth. This bucket is obviously imperative for longevity of our plans, and it gives us our market exposure. So, and just as a high level, when we're talking about risk in this particular part of our portfolio, we'll always ask on a scale of 1 to 10, 1 being the least amount of risk, 10 being the most, where do you fall on that continuum? And that's just a starting point for us because it gives us as representatives just an area to start. But another question that I ask my clients just to ascertain their risk is what are their return expectations for this part of their portfolio? And this is on both on the upside as well as the downside. So for example, if their upside number is 15%, let's say, so their expectation is that their portfolio is going to grow at 15%, but their downside tolerance is only 5%, then perhaps they aren't as risk tolerant as they might think they are. So we talked through that in great detail. I think to give a little bit more color in this space, I'll just give you an example of a client that I met with earlier in the week. So he came in, and he was really worried about the market. I mean, this is not uncommon based on what we've seen this year, but we've been working together for years. And he's in his second year of retirement. And really the biggest goal for both he and his wife is to be able to spend their money. So they've worked really hard to save it. So of course we want them to be able to spend it and just not worry about what's going to happen with the market. So being that we've seen some recent volatility, he has been a little bit more stressed than usual. So in addition to the volatility piece though, when we were updating his plan, we actually realized that he's spending a lot more money than we had planned for. So we updated the plan, updated his current expenses, got real about that. And then we revisited that emergency, protection, and growth bucket. So previously we had protected some principal for him, but after modeling in some income strategies based on his new expense levels, we determined that his plan would be actually much more successful with some guaranteed income built in as opposed to protecting that principal. We also revisited his growth bucket because he's very nervous about the market. So we discussed his risk tolerance. But with the income built in, we were actually able to increase the aggressive nature of his growth bucket because of that protection that we had in there. So we started the conversation with him being adverse to risk, but once we understood and addressed the emergency and the income built into the plan, one, we were able to increase his guaranteed income significantly to handle those expenses that were a little bit higher. Two, we increased his allocation from a 70-30 to an 85-15. So 70% stock, 30% bonds to 85-15. So we actually upped that allocation for him. And then three, we provide him with the confidence that he needed just to weather the market so that he could stick to the plan. So after this conversation and modeling all of this in, his plan was even more successful at the end of the meeting.
Jen, that's a really great example, and I love the notion of getting real about your expenses. Certainly shows how asset allocation works in a financial plan. So, Lars, what are your thoughts on how someone can determine their mix of stocks and bonds?
Yeah, so Susie, I think what you're trying to highlight is like if you're playing at home, how do I think through this? And I think the answer is it depends, right? So in my view, when you think about some of these broad asset classes that are really strategic in nature, things that probably most of us should always own in some capacity, whether it's US, international stocks, bonds, short-term investments, it can be quite personal, right? There is no one size fits all. There's no rule of thumb approach here. And that's why we do think it's so important to have a conversation with someone like Jennifer, because I think Jen just laid it all out here, to understanding your complete financial picture, your various goals. Like there's a lot to it. And then when you layer in the emotional capacity of it all, it can be really, really important that you have that right mix of asset classes, the blending, to provide you that path to a future financial goal. Because we do think it's quite important. You know, various studies have actually shown over the years that the vast majority, somewhere up to 90% of the variability between one and another portfolio really comes down to this asset allocation or that blending of stocks, bonds, and other broad investment asset classes. Now, for us back on the investment team at Strategic Advisors in managing our clients' critical assets, we really spend a lot of time thinking through this, building durable portfolios that align to the planning process that folks like Jen and her team do every day, because it's all about aligning the needs, the preferences, to the execution of the asset allocation. And that's not static. It's not a one and done, set it and forget it. Because as your situation changes or your financial goal changes, maybe you get closer to your goal, that mix of stocks and bonds, that can alter over time.
Yeah, and I'm glad you mentioned that, Lars. So yeah, things do change. Things are not static, and you mentioned a few things could potentially change with you personally as to why we would want to meet. Another one could be just a change in policy. So forget about politics, but think about policies changing. Now, this has happened a few times in the last several years. You've got the Secure Act 1 and 2. You have Tax Cuts and Jobs Act. You have the One Big Beautiful Bill, which just passed. Each of these things can potentially impact your investment strategy. So when policies change, we should probably react. And that's when we would want to meet. Does anything change for me personally first? And we can figure that out. And then obviously work with you to make the adjustments that will keep you invested.
Well, since Phil just mentioned tax changes and taxes are often on the minds of our clients, Lars, can you explain how tax concerns impact the way you put client portfolios together?
Yeah, this is everybody's favorite topic, Susie. Taxes, right? Because taxes do take a bite out of returns. So we do need to be thoughtful about it, in our opinion. So in our thinking for putting portfolios together for our clients, we do like to go a click deeper and really look to understand the various types of accounts an investor may have for a specific goal, as well as understanding tax rates and other pertinent information, because it can really matter. So let me maybe give you an example of how this can work. You know, many clients have a retirement goal, as Jen laid out earlier, but the accounts for that goal don't always have to be registered as retirement accounts in the traditional sense, like an IRA or a Roth IRA. Many investors may have critical assets in brokerage accounts and trusts that they are setting aside for a retirement goal. And in those types of accounts, taxes do matter. So when we're armed with this information, the asset allocation conversation turns into an asset location effort. And that's because it just may make sense, depending on your situation, to put certain investments, like, for example, bonds that pay interest consistently. It may actually make more sense to put more of those bonds in traditional IRA accounts where there isn't an annual tax impact that you may have to pay. Now, consider you could juxtapose that with putting higher octane investments like emerging market stocks that have the potential for capital appreciation. Those investments we actually may weigh more in things like Roth IRAs, where they have the potential to grow and be withdrawn tax-free. So it's a very simple example of how we think about asset allocation, asset location, and that impact of taxes.
All right, thank you for that, Lars. And as you said, it's everyone's favorite topic. So let's stay on the subject of taxes. So, Phil, we hear about this concept of tax efficient investing. How can Fidelity help with tax efficient investing?
Thank you. Yes, the problem statement is this: since 1926, the average investor has lost about 20% of their results investing in stocks, and for bonds, it's even worse. And I think a lot of people think it's a certainty; it's something that's going to impact my results. But I don't know if everyone realizes there are a variety of different things that we can do to potentially reduce the impact. So first, we must recognize this isn't a one and done proposition. It's not just do this once and then you're all set. It's year round. So that just in and of itself is important to understand. And then a diversified portfolio, simply put, there will be times when some of these investments decline. It happens on a daily basis. And it might feel like it's this uncomfortable moment. But it could also feel like an opportunity as well, because if you're, as an investor, you can sell a tax lot of some or all of a position at a loss and then invest the proceeds potentially into something very similar, not the same thing, but something similar to ensure that you stay invested. And then reconciling some of the losses that you've captured with gains that you have in other parts of the portfolio can actually help improve what you end up keeping potentially. So in addition, we can use tax-free bonds. We could use potentially more tax-efficient vehicles like exchange-traded funds, index funds, separately managed accounts. And let's not forget about there's things like capital gain distributions. And these can happen anytime throughout the year. And behind the scenes, what we try to do is understand the potential tax liability from action or inaction. And after we think about that, it's really just a math problem. Here's a hypothetical example. So with capital gain distributions, creating a tax liability at any time, what we try to do is determine, all right, if I do nothing and it costs me $5,000, and if I can do something and it only costs me $2,000, then we should probably explore that. We're not in market timing. We're just simply thinking about ways to improve your after-tax results. So tax loss harvesting, capital gains tax management, those are both independently very important. But what's important to understand is that plus some of the other things that I mentioned in combination with one another, which really can deliver the best types of results if we work together and allow these two techniques or 4 or 5 techniques to work together.
All right, super helpful, Phil. Thank you. All right, well, let's return back to asset allocation. And I want to talk about an asset class where many of our clients are overweight, and that's cash. So, Jen, a question we often get is how much is too much?
Absolutely. We get this question all the time, and it definitely varies client to client from that emotional place. So, cash oftentimes ties back to risk management in most clients' eyes, which it can often be a real big misconception. So, for this reason, you're going to hear me say this ad nauseum, but we go back to the plan. Having an implemented financial plan allows clients not to focus so much on day-to-day market volatility and allows them to weather market movement. So that being said, with cash, we're going to go back to that emergency location. So we want to make sure that that's funded appropriately. And once that's confirmed, it may make sense to reduce additional cash holdings across the board. There are several reasons that large cash positions may not reduce risk. For example, back to Lars' example of asset location, if you're holding cash in a retirement account, there's a potential impact on taxes on future distributions, which in some cases may produce a lower than expected after-tax return. For example, if you're getting a 4% return on a money market and you're in the 22% tax bracket, obviously you're going to have that potential to produce that lower than expected after-tax return. So for this reason, we generally suggest holding cash or cash equivalents in non-qualified accounts, meaning accounts that don't qualify for that special tax treatment. However, in these accounts, it's also important to consider that inflation can gradually eat away at the value of cash holdings in non-qualified accounts. So with these issues in mind, we generally recommend maintaining only essential expenses for the emergency reserves in the traditional cash positions. So if clients are holding excess cash due to concerns about risk and safety, then we look at cash money market alternatives just to get a little bit more yield on that. And so there's infinite strategies in this space, ranging from, as high-level examples, alternative investments, annuities, call put strategies, etc. But the bottom line is that it's important that we work together to explore more tax-efficient and inflation-conscious strategies that are really tailored to your specific needs and your risk tolerance.
Great. All right. So we talked about being overweight in a sector. Now let's look at a sector where many of our clients are underweight, and that's international stocks.
Mhm.
So, Lars, a two-parter for you. Why do you think some of our clients are hesitant about international stocks, and what role do they play in a portfolio?
Yeah, sure. I think that's right. And Susie, it's probably for a couple of reasons. And I presume the main one here is that non-US stocks have simply underperformed US stocks over the last 10 or 15 years. But there are probably some other reasons why US-based investors kind of are hesitant to invest overseas. And some of it just comes down to being unfamiliar with the names of some of these companies, right? We tend to like to invest in our own backyard, things that we use every day. But there are some really important diversification benefits. There are different growth exposures all around the world. There's a big world of different companies that are trying to grow earnings. And so maybe shifting to your second question, like kind of what are some of the compelling reasons why one may want to have a strategic piece of a portfolio like what we do for our clients in international stocks? I could come up with several reasons why, even right now. One is just the makeup of the non-US market does look different from the US market. You know, US stocks are more dominated by technology, large cap growth stocks today, and they're pretty concentrated at this moment. Now, when you look at places like Europe, for example, there's more exposure to banks, industrial companies. So that's reason one. A second reason is what we call valuations. It's simply just the prices you pay for future earnings, and they are different right now. So US stocks are currently pretty expensive. But investors have been getting paid for some of those earnings growth that we've seen, but there's a lot of high expectations baked into some of those valuations. That differs from non-US stocks, which are actually lower valuations, relatively speaking. So in other words, there's a lower bar for surprise to the upside for non-US stocks. Third reason, it would be currency movements. So when the US dollar is softening, like what we've seen this year versus many other non-US currencies, it can actually help boost the returns of international stocks when you get those translated back into dollars. So for much of the last 10 or 15 years, the US dollar has actually been posting pretty strong gains, and that's muted some of those international stock returns. We may be on the verge of seeing that trend shift. And that's something that we're actually pretty excited about in the management of our international stock allocations for clients. I think the final thing I might just say here is that we are seeing some deglobalization trends over the last handful of years. So if we go back and we think about what's gone on for the last 2-3 decades, we've seen an increase of globalization. And that effect, what it had was you saw more economies around the world shift together in synchronization. And over the last handful of years, we've actually seen less globalization and more things like rising trade barriers, rise of nationalism, a greater amount of reshoring or friendshoring. And so what that could actually mean is less synchronization of global economies and markets. And for an investor, what that could mean is that you see a little bit more zig and zag between US and non-US markets, which is a little of what we've seen this year. So it provides another element of diversification to well-diversified portfolios.
All right, Lars, super helpful. I'll let you off the hot seat for a moment here. Thank you. Now, what about going beyond stocks and bonds? Phil, can you help us here?
Definitely. I'll talk about going beyond stocks and bonds, but I'll also give you some context as to why this matters. So diversification, it's not just stocks and bonds, but it's the types of stocks and bonds in a lot of cases. So you've got the size of the companies that will matter, large companies all the way down to fairly small companies. We have companies that are more growth oriented, and then we have ones that are more value oriented. They might be very well established, but for whatever reason, they're less expensive or something. There are various countries, as Lars mentioned, but then within stocks and bonds, for example, you have government bonds, high yield bonds. You've got short term, long term things that go up when other things go down. It can become pretty complicated, but that's the idea, is to diversify and spread out your investments. Now, allow me to provide a little bit of context as to why this might matter more than you realize. So in the event that we go into a recession, typically what has happened in the past is smaller companies might struggle more. It's natural. They're not as well established. Coming out of a recession, a few of those types of names and companies could represent a nice opportunity. It doesn't always work that way, but that's the idea. And that's why you want to diversify away from just one specific part of the world or part of the market. And I think that's really important to understand.
All right, great. Thanks, Phil. Now, once someone has put together an asset allocation, what should actually go into their account? All right, Lars, put you back on the hot seat here.
I'd be happy to answer it. Now, I'll answer it from what we do for our clients, and maybe you can layer it in as if you're doing this on your own. But once we've identified that asset allocation, we've talked about now pretty deeply. We really rigorously think about the research of the kind of investments or the kind of investment managers we really want to own to help grow or manage risk in our client portfolios. So this is kind of the execution of that asset allocation. How do you implement it? And how those managers, those various investment managers are out there, they come in different types of vehicles, right? So we've touched upon this in a couple of different answers from Jen and Phil. There are some mutual funds. They could be index or passively managed funds. We have actively managed mutual funds. There's ETFs. There's separately managed accounts, otherwise known as SMAs. Those are just some of the most common vehicles that are out there. And there are really no right or wrong answers here, Susie, but they all come with their various advantages. Some are more tax efficient, like ETFs and SMAs. So they may be better suited, depending on your situation, for taxable accounts. Now, if you think about various actively managed mutual funds, they can actually be quite useful in our view in tax deferred accounts. So IRAs, Roth IRAs, that's where capital gains just aren't taxed from year to year. And these funds actually are trying to make moves in each year where you have potential capital gains and the taxes associated with them might weigh on returns if they were held in a taxable account. But they do provide you that enhanced growth over time, potentially. And we do need to point out, though, that when withdrawals are made, you are subject to the ordinary income tax on those distributed amounts in various traditional IRAs. But that really differs from like passively managed mutual funds like index funds. And so where the objective here is to simply track some broad market index, they are more tax efficient because they're not trying to make as many moves to try to add value in maybe picking this stock versus that stock. And so we use these different vehicles in different ways. And that's where we spend a lot of our time thinking about not only the vehicles where they might be used, but the kinds of what we believe to be above average active managers. We're really trying to find those managers to implement in those vehicles to try to add value over time for our clients.
Awesome. That's a very helpful overview. Thank you. All right. Well, of course, creating an investment strategy isn't a one and done thing. Thanks. That's the name of this webinar today. So, for example, I might have a different point of view at the age of 50 when I'm saving compared to when I'm 70 and already retired. So, how do you help clients keep their investment strategy in line with their time horizon and risk tolerance over time? Jen, please help us.
I will definitely help in this space. So, as we know, financial plans and investment strategies are fluid. They obviously change over time. We're not the same person we are at 20 as we are 50, et cetera. So, it's my job to ensure that financial plans are sustainable for the lifetime of clients. This is why it's just critical that we have updated plans at minimum annually. But I also educate clients that if something happens unexpectedly, alert us right away. We're here to help. So the benefit of one, creating a plan, but more importantly, implementing that plan is that we can address needs as they change and adapt and grow. So your asset allocation potentially could be the same at 50 as it is at 70. But obviously when we retire, we want to make sure that we've got things like income covered because you're no longer earning, if that makes sense. So let's go back to that client example I mentioned earlier. In that case, he is retired, he is approaching 70, and we actually increased his allocation in retirement based on protecting that income. So not only did we make his growth bucket more aggressive, we also increased the health of his plan. I'll give you another couple examples just to highlight in other spaces. So I met with another client. She is single and she retired a year ago. She amassed a lot of wealth over the course of her lifetime because she's really, really good at saving, but also wildly novice when it comes to the market. So when she retired, we added protection into her plan. So between her pension, her Social Security, and that protected piece, her entire income needs were covered for her entire retirement because she didn't want to worry about that market volatility. She recently, unfortunately, was diagnosed with an illness that is going to impact her longevity. And when we revisited her plan, her biggest goal was actually now to leave a legacy for her girls. Because her lifestyle was covered and the goal changed, in this example as well, we increased her allocation. So she originally was at a 50-50. We bumped her to a 60-40 so that we'd have potential more growth over the course of her lifetime. Again, another example of increasing that risk tolerance despite being in retirement. Now, on the flip side, I met with a 47-year-old client recently, and she's absolutely terrified about the market. She understands it's irrational, but she inherited her money from her aunt, and she just wants to make sure that she's an amazing steward of this bucket of money. So while it is her goal to have this grow for her retirement, our recommendation for her was actually a 100% equity portfolio. And this was based on her plan, her age, even with that risk tolerance built in, and because we have a long runway here, we have a big time frame. But after discussing her feelings and just understanding that she emotionally could not handle a 100% stock portfolio, we actually dialed down her risk to a 70-30. So I give you all of these examples just to show that allocation is absolutely not age-based, but it's 100% goal-based.
Well, Jen, those are really great examples, and I do hope your client is feeling better. Now, you talked about volatility and being one of your clients being scared of the market. So, thinking about the markets and when they're volatile, clients often contemplate making changes. So, how should someone manage their portfolio through periods of market volatility?
You're going to hear me say this 1,000 times again, so I hate to be boring and redundant, but honestly, stick to the plan, right? The biggest mistake I see with self-directed clients is panic selling. I had a client recently call me, and his direct quote was, "Jen, I made a big mistake and I should have called you." And he wasn't kidding either. So what he did resulted in a $500,000 plus capital gain event. So he holds significant assets in both qualified accounts, so think IRA, 401k, Roths, as well as those non-qualified accounts, so after tax. When we saw some volatility in March, he panicked and he completely sold out of his non-qualified accounts to get, add that protection for money market there. While I would definitely not have advised this approach given the opportunity, I would have suggested that we actually reduce his risk in his qualified accounts, because that wouldn't have created a taxable event for him. So we still could have handled that panic moment, but have done it a little bit more tax efficiently. At the end of the day, he is now turning all of his accounts over to us to manage, and we have the ability, as both Lars and Phil mentioned earlier, to do some tax efficiency here. Harvest tax losses throughout the rest of the year, hopefully help reduce that capital gain bill. And to his points, he just wants us to help him not make mistakes. So I understand completely that this is an extreme example, but it's also a good reminder that we, as representatives here at Fidelity, are committed to helping more people. So please know we are here to offer complimentary guidance to you, whether wherever you are on that financial journey and whether we're managing your assets or not. So again, sticking to the plan, I have hybrid or self-directed clients that love volatility because they see it as an opportunity to buy. And this is a wonderful approach given the opportunity, but also considerations should of course be made as to what to purchase and in what kind of registration. And then of course the clients that Lars and his team are managing, we just review the plan. I mean, if we have a financial plan that's implemented, we go back to it and we just remind that, you've got your emergency reserves covered, you have your protection covered, and Lars and his team will make the day-to-day changes in the investment strategy. But at the end of the day, just sticking to the plan and staying course is very important, especially during volatile times.
Well, Jen, I'm not sure I'm clear. So do you want us to stick to the plan?
I do. I really, really do.
All right. Phil, would love to pull you in here. How can looking at market history help?
Yeah, a couple of things. One, you definitely want to know your market history, and then relying on your financial representative to get updated stuff from Fidelity is huge. So historically, it's possible to experience really significant losses. We call them bear markets. They happen every 3 to 5 years or so. You're down 20%. Now that's happened 3 times in the last 7 years, and that's remarkable. And what you're looking at on the chart here today is the juxtaposition between sentiment, so how do we feel, and then how do things typically do afterwards. So as you can imagine, when you're in the middle of it, it feels really bad. And then afterwards, things calm down, we get more information. And as the market digests things, things tend to rebound and so forth. So you can see that here on the slide. It's not by any means a predictor of future performance. So obviously we know that it's impossible to predict what's going to happen next. But what the context can do is help provide some perspective on things that have happened in the past that are similar. They're not the same, but they're similar. And in the event that we feel terrible and we make a mistake, it can really meaningfully impact our long-term results. And that's why it's important to pay attention to what has happened in the past, because perhaps you were a different person then, post 9/11 or post financial crisis, than you are today. But that feeling can prevent us from making really good investment decisions. And frankly, it can keep us from sticking to the plan.
All right, very helpful, Phil. Thank you. We know that many clients measure their portfolio against a benchmark like the S&P 500. So, Jen, is that the right way to measure success?
This is a fan favorite for me, honestly, because 90+% of clients call me about performance. And this is going to make Lars shiver, but they base it on their favorite indices. So whether that be the NASDAQ, the Dow, the S&P. But at the end of the day, we know that a diversified portfolio cannot be compared to one specific index. So when we're benchmarking performance, again, we're extremely transparent about performance and making sure that it's visible to our clients. So on fidelity.com, there is a performance tab, and that shows up-to-date performance on all accounts. If we're actively managing an account for you, we can also add a personalized benchmark just to show how we're performing next to that. So at the end of the day, the most important thing when benchmarking is that we're doing so apples to apples.
Great. Well, speaking of that broader market, Lars, we last spoke to you in December, and at the time, your outlook was positive for continued growth. Now, has that changed, especially given things like new tariffs that have the potential to impact the economy?
Yeah, it feels so long ago, doesn't it, Susie? It was just December, but it feels like ages ago to so many of us. And frankly, I'm probably one of the optimists in the organization here that over time, growth is usually on our side. It all depends on time horizon, right? So if we're thinking about a very short-term time horizon here, if we're just talking a few months, well, things could be a bit bumpy. They may be a bit more volatile, and that's why we're trying to provide a smoother ride with diversified investments. But over the long term, I think time is on your side. And that's a little what Jen and Phil have been trying to illustrate through some of their comments. But if we go back to really thinking about the markets this year, they thrive on predictability. And when you see things like fiscal, monetary, and trade policies that are just very unclear and uncertain, it's not uncommon for markets to fluctuate and business spending becomes more cautious. So that's certainly the feeling so far in 2025. But really, despite the uncertainty, the US economy is still continuing to grow. It's supported by some healthy corporate profits. We still have stable consumer spending, and we do have that spending backed by a steady but cooling jobs market. So looking ahead, some of the things that we're thinking about and watching quite closely in the investment team at Strategic Advisors is how those key drivers of the economy and the markets, how they may be impacted by some of the government policies that are coming about. So, for example, tariffs. I think we've been very clear about this over the last several months or longer, is that they may blunt growth and soften job hiring as they do raise costs for businesses and consumer prices alike. However, we need to think about things beyond just a microcosm of just one thing. Let's just go out one click and not forget that Phil mentioned it earlier. We had this recent package passed through a reconciliation process by the federal government, which had various tax cuts and corporate incentives in them. And those policy changes actually could be supportive for growth in the coming quarters and years. So you put it all together, it's kind of a muddled mix of potential policy impacts here. But I think the most important thing is we don't see to be facing an imminent recession on the horizon. Rather, it's probably a period we're going through here in the U.S. economy of moderating pace of growth with the potential for firming inflation, but coming from maybe those tariffs that are starting to come into place. So with that as a backdrop, some of the things that we've tried to do around the edges of a client's strategic asset allocation mix is we've actually tilted a little bit more into international stocks and slightly less US stocks. Now, this is right on the margins, right? We still want to be very invested against our clients' financial plans, but that just gives you an idea. It's just trying to add a little bit of value from what we see in the current landscape in the markets and the economy. Now, because we see some of those potential policy impacts like tariffs and whatnot, that may add a little or firm up inflation. We do have a smattering of all these other opportunistic allocations. These are things that kind of come and go over time. We don't always own them. So I'll give you an example. We've had higher allocations over the last 6 to 9 months in things like treasury inflation protected securities, commodities, REITs, some liquid alternatives. They all serve various roles. But one of the things that they're there for is those surprises on the upside for inflation and the potential for some bouts of volatility. So all of this I'm highlighting are some things we're doing. We think it's still a positive time to be invested, and particularly if you're investing to some long-term goal. But these are things that we do for our clients so they don't have to, right? That's really why we're here. It really doubles down on what Jen was saying earlier, that we're just here to help.
Super helpful overview. A quick follow-up. What's your expectation for interest rates this year? Are we likely to see more cuts?
Yeah, well, the environment I just laid out, Susie, it's still being, fairly positive for economic growth. And by that cooling jobs market, that potential for higher prices coming from tariffs, that is leading to a fairly cautious Federal Reserve. Now, the Federal Reserve here in the US is the central bank that tries to dictate where very, very, very short-term interest rates, the direction of those has nothing to do really with the 10-year bond or the 30-year US Treasuries, And the Federal Reserve, they've left interest rates unchanged since last December. But bond markets are currently pricing in 2 cuts for the balance of 2025. Now, we'll see what happens. I think if growth remains positive and inflation shifts higher, perhaps the Fed won't cut twice. But what if we see inflation continue to cool and maybe we see rising unemployment? Maybe the Fed could take more action. Now, we're not trying to prognosticate on exactly what that might happen in the next 6 months. We want to adapt to where things are. I would say, look, if we did see lower interest rates from the Fed, that would probably be a boost to the economy because it provides that potential for borrowing and support to economic growth. But the Fed is being cautious about this. They're trying to slow their decision making down here because they're afraid to maybe reignite inflation should those tariff-induced pricing pressures actually emerge in the coming months. So I think in the meantime, as investors, we can take solace with the fact that still relatively high interest rates are providing bond investors with an income and a boost to those future bond returns that we would believe would come from having those higher interest rates.
All right, thank you, Lars. So circling back, we've talked about setting goals and the different options for investments. So let's talk about implementing your plan. What are some of the different ways Fidelity can help you? And Phil, can you talk about some of the tools available for investors who want to do it more on their own?
Yeah, thank you for the opportunity. Yeah, we have portfolio builder tools, retirement planning tools that Jen has access to and others, but they're all available for you, which is great. And if you want to find what we have, a good place to go would just be to go to fidelity.com, and then right along the banner, you can click on planning and advice. And when you click on that, go into the planning and guidance center and find out what we offer. So when you click on what we offer, it will show you a litany of different things that you can use, tools and resources that will help you make decisions. Here are a few that many of us have to make. So I have 4 children. I want to understand what it might cost to send them all to college. So there's college savings tools. There are Roth conversions that, because of policy changes, Roth conversions could be more or less attractive, but might be something that you want to investigate. And the timing of that really matters. So we have tools that you can use yourself. You can use in conjunction with someone here at Fidelity. And we want to just meet you where you are. One thing, as I mentioned earlier, people are afraid of running out of money in retirement. And I believe Jen mentioned it several times. Predictable income is something that almost everyone we talk to who's retiring is looking for. There is a guaranteed income estimator tool, which is great. It says, oh, gosh, I've saved some money. How much would I have to carve out to get the income that I actually need? And that can give you some useful information when it comes to making important decisions. So whether it's you all by yourself, a little bit of our help or a lot of our help, we're here to help you. And we have a lot of clients, but our goal is to help more and more of you every day. So please take us up on the offer. Thank you.
All right, well, as a follow-up to that, Jen, can you talk about what it's like to have your money managed by Fidelity?
Absolutely. Like Phil said, I mean, we're an amazing platform for self-directed clients and or those who are kind of like a hybrid planner or those that we fully manage. So we manage your accounts with the assistance of obviously our experienced managers like Lars and his peers. My job, if it's not clear enough, is to help build the plan and then determine what we need to do in terms of allocation, strategy, those types of things. But Lars and his teams do the dirty work. They run day-to-day investment choices and changes and all of those good things 24/7 to make sure that we're investing in the proper things within your managed accounts. So those of us who are having their accounts managed, we do have a management fee for any portion of your account that might be managed by us. And this ranges based on strategy, based on the amount of assets we're managing, but just to give kind of a high level feel of what that is, ranging from 0.25% to 1.5%. And again, investment minimums apply, and it's very specific to whatever strategy we're implementing. So that is where the management fee comes in. A lot of my clients actually land in this hybrid space where they love to have a play account. For example, they're very interested in the market. They want to be able to buy and sell some things, but they're also super clear that they want their critical assets looked at us by us every single day. So in this space, for that play account or the stuff that they're managing on their own, no management fee attached to that. When we're managing your assets, our management fee is just based on the amount and strategy that we're managing on this end.
Awesome. Well, panelists, you've given our viewers so much to think about. Before we sign off, could each of you share a few key takeaways? And Phil, let's start with you.
Definitely. I'm hoping that the audience can take away that if you combine ongoing financial planning with active asset management, you may have the opportunity to just make better decisions about your future. Nothing's perfect, but we seek to provide better clarity and perspective when you can retire, how much you can give to your charities, which colleges can you afford for your children. Without a disciplined plan combining growth potential, predictability, our clients and anyone can lose sight of the distant future. And you've got that all the time when there's a geopolitical concern, something pops up, current events can mute everything that we've worked for and everything that we've planned for that's going to happen, further down the road. And frankly, it can be a really big distraction. So I've mentioned this a few times. We want to help you build a plan that you can stick with, and it gives you the most effective chance, highest probability for success, and increases your confidence so you can live the life that you desire and not the one that's forced on you.
Susie, I'll be a fast follow because I think that was very well said, Phil. And I might just add on to that setting up the plan to give you that potentially best chance of meeting your future financial goals, whatever they are. That also requires a very thoughtful and disciplined investment process along the way. And that process really that an investor employs can pay dividends over the long term because what it can do is it helps eliminate the need to feel as though you need to do something every time there is a news event or a market event. It's to help overcome those emotional challenges of investing to a longer term goal. So simply put, maybe my takeaway is a time-tested, disciplined investment process can really help investors stay invested during those moments when markets wobble, which are inevitable, and maybe benefit from the potential growth when markets rebound, sometimes quite quickly, like what we saw in recent months.
And lastly, I will just jump in here and shock you all by saying we want you to stick to your plan. So I would add, Lars and Phil nailed it in terms of everything that they said. I would just add that as Fidelity representatives, we are absolutely passionate about helping more people, and we truly mean that. So please engage us to help build out your financial plan. We want to support you. We want to meet you where you're at. So please take us up on that.
Well, thank you, Jen, Phil, Lars. I'll wrap things up. If you have more questions about creating an investment plan, please reach out to your Fidelity representative. And if you don't have a representative, visit fidelity.com/find an advisor. And for more timely market updates and insights on other financial planning topics, subscribe to Insights from Fidelity Wealth Management for exclusive invitations to future wealth management webinars and access to our weekly newsletter. So thank you again for joining us.